Let's bring in, he's huge now. He's big. He's like you're not MAGA, you're mega. Chicago Fed President Austan Goolsbee. He's former CEA chair in the Obama administration. Mr. President, thanks for joining us.
Thanks for having me back, Joe. It's good to see
you. How is your health and how are you sleeping? It's a big job you have, and I'll tell you why I'm asking that. We have a lot of people on that almost describe the risks as completely symmetrical. In other words, they say that a stop-and-start Fed policy that lets inflation stay alive is the worst thing that we could do. Then there's other people that say the Fed stayed at zero for too long. Why wouldn't they go too far in terms of hiking and actually put us into a much harder landing than necessary? Which risk keeps you up at night or makes you worry more?
I'd say the risk of inflation staying higher than where we want it is the bigger risk. I'd say it's the bigger risk.
Did they talk you into that, Austin? Because I thought you were more. No. The word was that maybe you didn't want to do some of the recent, or that you were sort of dragged into doing some of the recent hikes, and that you thought maybe we should stand pat. That wasn't true?
Well, probably not. Well, but I mean, it depends which meeting. I voted. We've all voted together at each of the meetings. And look, the thing is, as you know, the Fed's got a dual mandate: maximize employment, stabilize prices. The employment side has been going very well. So our focus, we've got to get the inflation back down to target. But I think we're doing it. And so far, we've been on a path which is quite unusual historically, where we've been getting the inflation rate down without driving up the unemployment rate. Now, these external shocks, I'm going to call them, have derailed the Fed trying to nail a soft landing in the past. So let's keep an eye on it. And those are the kinds of things that are keeping me up right now. But we ought to have 100% commitment that we're going to get inflation back to the target. I mean, and I think there are markers that we can watch to do that.
And that's not going to change. 2% target is not going to change. I'm ready to declare victory.
I don't think it's going to change.
No?
Look, I think it's unhealthy that people speculate. You cannot change your target if you haven't reached the target. I mean, you find you can have some debate when you're at target, whether that's the right target. But if you undermine the target and say, well, maybe let's give up because we haven't gotten back to it, that defeats the whole purpose.
Is it possible, Austin, that I use it more and more, the expression that things happen gradually and then all at once? Is it possible that the lag kicks in a sort of a quantum way where suddenly things really do slow quickly?
Well, I mean, you're getting all science on me now, Joe. Look, the thing
there are smart
is,
guys.
Yes, that's possible.
There are people that say
possible.
The Fed's done. There are people that say the last rate hike is in. Gunlack and other smart people that say we're going to see that there's no way that they've already at least accomplished restrictive, and that it's going to restrict itself with China and with oil prices at 90 and with strikes and all these other things are going to. The Fed doesn't need to do anything else.
We don't know, but it is certainly possible. And there's one worldview which says, traditionally, historically, it takes several years for the impact of monetary policy to work its way through. So things might get worse in the coming months and years based on what we already did. Now, that said, if you look, I've been trying to emphasize that pretty soon in here, the question is going to stop being, well, how much more are they going to raise? And it's going to transform into how long do we need to hold rates at this kind of restricted level to feel convinced that we're back on this path to 2%. And that's healthy. That's what we want it to be. So we're just going to have to play by ear how much is still coming down the pipe versus how much was expected and was already in there. But I think we're getting close to this spot where it's going to be more about the how long we hold rather than how high we go.
And what's your view on how long? Because there's a lot of disagreement when it comes to that, too, Austan.
It feels like it's a little longer than what the market was expecting when we released the last statement of projections. So if you look at the median SEP dot from the dot plot, it's got the rates holding, well into next year. And that was a little longer than it seemed like what the market had thought before that came out.
We had the father, Austan, of the inverted yield curve prediction recession indicator on, and he said it's like next month is when he said it's been wrong. It's
they keep just saying, look, it's been wrong for 2 years or something, but they just keep saying, just wait, wait. It's
happening. It's coming. But you yourself noted how rare it is to not see anything in the employment sector when you've gone up 500 basis points. Is it so? I wonder whether. So you don't think we're on the cusp or already in a slowdown, a real one?
It's slow. It's slowed a bit, but look, the unemployment rate is still basically what it was when inflation was almost twice as high as it is now. So you at least got to say, I've been calling that the golden path, and I think it's possible. But look, there are a lot of risks, and the path is long and winding. But the thing is, the inverted yield curve is just the clearest manifestation of a mentality, which is, let's look at the past and see what happened in the past. That's what's going to happen in the future. There are some things going on in the economy right now and the coming out of COVID aspects that are unique that have made predictions based on what happened in previous business cycles look kind of goofy. So that rule might not apply.